Hey, everybody, welcome to the Closing Beat again. Happy Wednesday to you. How's it going out there? Good. Appreciate your patience as we kind of like recover from the hurricane here and get everything set back up. Had some equipment issues in the office, and so we're getting that fixed. That should be fixed tomorrow. But so I don't want to miss you guys, right? So we're going to do a great closing beat here today. We are financial advisors at Jazz Wealth. Hope you'll check us out at jazzwealth.com. If you're working with one of the big guys, you got a Roth IRA, an old 401k or something, and nobody's helping you and you're getting no guidance or anything, or maybe the performance is a little weak, go to jazzwealth.com. We can roll over that old 401k, transfer the Roth IRA, whatever you like. Also, there will be a Wine and Wealth tomorrow. We missed last week because of the hurricane there, but we will be back there. But you're not here to hear about that. You're here to talk about the stock market, and we are going to talk about it. Now, yesterday, we had a little bit of a reversal, right? We go over to the charts. Here's the S&P. So in the middle of this uptrend here, a little bit of a reversal. Is it going to pull back? And if so, what does it matter? Or are we just going to kind of keep trending higher? Well, at the moment, you can see that right in here, this is going to be the area where everybody's looking at. And I'm actually just going to draw the line and leave it there. This is what's known as your last support area. It is technically still called a minor support area, not a major support area. So a lot of maybe what we saw from yesterday and a little bit of the sluggishness today lends some guidance towards maybe just working our way back. And you would call that mean reversion. You wouldn't really call that a pullback, but anything underneath that is where people start to throw in the towel a little bit in this midterm uptrend, at least if they're technical traders and people that like to follow that. So anything that breaks below that, you'd have every right to believe that people would believe in a more significant pullback. But for the moment, we're just kind of chopping around here, waiting for earnings to come through and, what's it going to be? Who's reporting and did they beat and all that stuff? And what impact do they have on the market? So not a lot to glean from that. Now, we're longer term investors here, but we like to talk about the day to day just to get a glimpse into what we may be seeing going forward. Now, here's what I see. Today, you've got the S&P up, 20 something points, right? 23, 24 points or something. Well, on the screen here, what I'm showing is 11, let's just call it 12 points of that comes from NVIDIA and NVIDIA only because of its rally today. So that's very close to 50% of the entire day's gains in the S&P coming from one singular stock. And if you look down the list, UNH, it's a large market cap stock. So you go, all right, well, I could see, 2 points there, 1 point and 1 point and so on. Everybody doing a little bit, but the bulk of the action today came from NVIDIA. And that's hard to get excited about a stock market rally when only one of the stocks is really doing a lot of the heavy lifting in one day. Now, if you look at the Dow, you're going to see the headlines there. What'd they do? A 300-point day. Oh my gosh, what a great rally in the Dow. But still, only 3 stocks, right? 10% of the Dow gained most of the day's value. You could even throw in Caterpillar as well. So a little bit of what we would call narrow breadth, and that just means a lack of participation. So UNH doing the most participating, Visa, Goldman Sachs, and then it starts dripping off really quickly there for the rest of them. So it's like, did we have a lot of participation today? No. Do we believe that everyone is betting on the market going higher today? No, it was very selective and a little bit difficult to get excited about just this one day. Nonetheless, you got the S&P over here yesterday. What we did is we talked about the percentage of stocks in the financials, right? So we looked at the financials and we said, well, let's look at the percentage of stocks making new highs. Well, I saw a great question there where somebody said, well, that's just the financials. Let's look at the S&P as a whole there. What's going on with them? Well, in the S&P, we're currently at 22.27% of stocks in the S&P making new highs. Well, let's look over the last 10 years and see, is that a high number? Is that a low number or what? Well, as you can see here, over the last decade, we've certainly seen a greater percentage of stocks making new highs, right? A little bit here and there and here and there. But we're getting to what the market would see as an extreme number of stocks making new highs. That doesn't mean that we fall, right? We could certainly just go sideways and not make new highs for a while. So don't let me trick you there. But we're getting to an extreme. There's a lot of little things under the surface of the market where you're like, okay, it's not bad. I don't know that we'd say doom and gloom from here, but it's starting to get just a little bit frothy. And I think it's really early to say that still, but you can kind of see all the metrics we're putting forward here. We got the financials, net percentage of stocks making new highs getting a little extreme. The S&P, not necessarily extreme, but getting to those upper limits of what we have. And so that makes it, well, just a little difficult to say, back the truck up and bet the farm on the US markets here at this point, as far as your longer term investments go. If you're a trader, you like the short term stuff, all right, that's different. I'd encourage you to come over to our research site, jazzwealth.com/research. It's $13 a month if you're not a client. It's free if you're a client. And we do the shorter term stuff just for fun because, well, that's a lot of fun. All right, as far as earnings go, in the S&P, we have 91% of stocks in the S&P beating on earnings, 87% beating on sales or revenue, however you want to say it. That number, both of those numbers are definitely going to go down. Remember, we only have 27 stocks in the entire S&P that have reported. So, it's normal to see the numbers change quite a bit. I do want to point out that the average stock reaction so far to earnings has been 1.87%. I'm sorry, 1.78%. The average stock reaction, meaning if they reported in the morning, then the current day, the average response is about let's call it a 2% move. If they report at night, then the average next day move is about 2%. But that's not all stocks, right? Your leader at the moment, the stock that had the biggest move on earnings is Walgreens, trying to come off the bottom here, closing 1,200 locations. They're all going to be Halloween superstores at this point, right? Do you know what I'm talking about? Who knows what I'm talking about? And the worst would be United Healthcare. They really had the worst, but since have recovered. It fell 8% on its earnings day. So those would be the two outliers on both sides there. Now, let's do this real quick. If you look at the NASDAQ, basically flat there. The Dow, oh my God, 300-point day, but we know it's just because of a couple stocks. The Russell 2000, small caps waking back up again. We're happy to see that. And bonds, at least rates, falling a little bit, maybe settling into a range. Oil has fallen quiet. There's not much to do there after, we got the short-term geopolitical news out of the way and what we talked about yesterday. Now we go back to supply, right? That's the whole focus there. I do want to point out, though, something, right? We have the S&P rallying, and this would be another thing to kind of highlight, I'm not so sure about this thing just, rip into new highs, and all of a sudden we miss a 5% move or something in the next 5 days. The reason is, that back in the day, way back in the day, what was the Dow called? And still called today, but we don't often say it. The Dow Jones Industrial Average. And it was largely comprised of transportation stocks. Because in the US, we used to manufacture stuff. I'm talking way back. We used to manufacture stuff, and then we had to get that stuff from place to place. So if you wanted a healthy glimpse of what the economy was doing, the smart investors would look at the transportation stocks and go, what are they doing? Are they transporting more goods? Because we're manufacturing all kinds of stuff here. Well, that faded away over time, right? Whether you agree or disagree, or we're not going to get into this, but we don't make much here in the US anymore relative to what we did. So now how do we get a glimpse of the economy? Well, everything you touch, every little piece of equipment that's in here has some version of a chip inside of it. In other words, semiconductors, right? So now what we do is, instead of saying we look at transports, the world looks at the semiconductors. And as well, the things that we do buy have chips inside of them, the computers, the cell phones, all that stuff, the cameras, right? So we want to know how these guys are doing. How the semis go, so goes the economy, right? Even if we import a lot of this stuff, or we're working on doing it. This is like the transports of the 21st century, right? And so they get a lot of attention, and you know that, right? Looking at NVIDIA and all of that stuff. Well, the semiconductors have had a rough move here, and a lot of that yesterday was due to ASML. It had its worst day since COVID. That was the 16% drop. And then add to that today, that's going to be its worst 2-day stretch since before COVID. So a little bit rough for them. But what that means is, we have semiconductors not participating largely, right? Like as a whole, as a little industry here. And that's tricky because we can't have a sustainable market rally without the semiconductors. NVIDIA, of course, right? NVIDIA is one of the, if not actually now, the biggest company inside the S&P. Well, the S&P can't go anywhere without the semiconductors going with them. What's happened? Semiconductors are not near new highs, right? They're being sluggish right inside here. So it's another little glimpse into, I want to like this. I want to get excited about even the smallest of little pullbacks here, But as a longer term investor, the day-to-day stuff is starting to make you want to just chill a little bit. Now, before we move on, economic wise, do you care about this stuff? I don't know if you could, let's just see. Let's see what you think here. The Federal Reserve puts out this study, and well, they track this constantly, but they publish it, I should say, frequently. And what they're looking at is how easy is it for the average consumer to get credit if they desire credit, right? Various levels of debt. And so what happened there for a while is it was really tricky to get debt. The higher that this, we're going to use the dark blue line for a second. The higher that is, the harder it is to get credit. Well, that's been fading away here. It's become easier and easier to get credit, which you think would be a good thing because we would use that credit hopefully to improve our net worth or go out. This is not just like credit cards, right? We would use it to invest in rental properties or get a loan for our small business or whatever. And the easier we can get that credit, the more we can add to the economy is the belief there. It's not all debt in the traditional personal finance space. Well, looking forward a year, people believe that it will still be easy and easier to get various levels of credit. Well, that's fine, right? That's actually seems like good news. The trouble is the probability of someone missing a credit payment or a debt payment in the next 3 months is working its way higher. And the red dots just signify each September so we could see if it's a seasonal thing or whatever. So we're finding it easier to get debt. We're taking on that more debt. But since the probability of us missing a debt payment is going up, could it be that some of us are taking on debt in order to meet expenses? And that's the sort of underlying quiet conversation that's getting a little bit louder, and a little bit louder there, right? So let's just be, it's just something to watch. It's not necessarily like doom and gloom. It's just one of those things where we track everything here. We want to know, man, should we be a little bit worried about that or what? Let's do some stocks in the news now. Get out of your way here. What's going to be earnings wise, right? Like Morgan Stanley was the last of the big banks to report their earnings. I mean, the real big, like global money center banks, they were the last to report. As far as they did better on pretty much across the board there. Wealth management sticks out. I like to look at that part of their business there because that's what we do here. And they did better than expected in their wealth management division. And Jazz Wealth is cheaper. So I'm just saying, like if you're over there and you're letting them make all that money off of you and the mutual fund fees and all the 12B1 fees and stuff that they charge, maybe you consider Jazz. Our funds have no fees. They're zero cost, right? And of course, we'll help with more things as well. So skip the big guys. Come on over to Jazz. Otherwise, if you look at Morgan Stanley as a stock, this is yet another stock. We talked about it yesterday that is overbought in the short term. It makes it very difficult to want to chase at this point. And what we mentioned, when stocks go parabolic, we talked about China yesterday, right? Going parabolic, in other words, like a hockey stick, kind of straight up there. What happens? The most amount of volume comes in, which means it's the most amount of people chasing at the highest possible price, which means what? They're the most emotional because the smallest moves create losses immediately for them versus a longer term investor who can say, oh, I'm just going to hold and enjoy this ride. It'll probably pull back and that's fine, but so be it. Qualcomm says, hey, we don't like the political environment. We're going to wait until after to talk about a deal with Intel. So they'll see what happens there. They're waiting until after the election, by the way. United Airlines, man, this is, if you're in our office trades segment there, we're in a little bit of trouble with United Airlines. We're going to be doing something that is known as being inverted on this trade as we play defense, but good for them today. They have earnings come out there. They actually did really well. Gas prices, of course, starting to help. That was just a comment that was not in their actual earnings report. And then Alta Salon says that we see a little bit of a slowdown out there and people buying the old beauty products and doing things like that. So maybe that's puts a little bit of a lid on them for the short term. I don't know. We will see. Other than that, here's what you got tomorrow. You got earnings from, we're getting into like the regional banks now. So Huntington Bank, Key Bank, things like that. Manchester, Travelers Insurance will be reporting there. And then after hours, no one's going to care about all of that because they'll be watching Netflix to see what their earnings come out to be. Netflix beats 81% of the time, 64% of the time on sales. And it is kind of interesting. The last two earnings reports, the stock was up. The two before that, the stock was down. The two before that, the stock was up. And the two before that, the stock was down. So it's a pattern. So would that mean that this earnings report, no matter what they say, would be down 2222. I know, I say these things and I know it's a stupid way to look at it, but I'm having fun with you. You know what I mean? Hey, I hope you'll check us out at Jazz Wealth. We are actively trying to grow here. If you'd like to schedule a call, you're working with someone at Morgan Stanley, Wells Fargo, or whatever, and you're like, I don't even know these people. Well, you know me, you know Chris, you know Eric, you know Baby Jazz. We're always here, happy to help you guys in any way. And we'll be back tomorrow, hopefully from the office, to do this all over again. Enjoy the rest of your day. Thank you.